Rhea Finance lost $7.6 million after attackers tricked its pricing oracle, and the risk now sits inside DeFi's weakest data layer. The Rhea Finance SEC problem is not a courtroom story. It is a security failure around how a protocol decides what collateral is worth. Attackers created fake token contracts, added liquidity to new pools, and made those tokens look valuable enough for the lending system to accept them. That makes the incident less about one bad trade and more about how DeFi systems decide what counts as real market data before they release borrowed assets. The weak point was price credibility, not the existence of borrowing itself. The mechanism is simple once the jargon is stripped away. An oracle is a pricing tool. It tells a lending protocol what an asset is worth before the protocol lets someone borrow against it. If the oracle believes a fake market has real value, the lending contract can hand out real assets against collateral that later turns out to be nearly worthless. A strong oracle setup usually looks beyond a tiny fresh pool and asks whether the market has depth, history, and enough independent trading to support the quoted value. That history check is the difference between a real market and a manufactured one. The breach hit the margin trading side, where borrowed money can amplify losses. The key path ran through Rhea Lend, while the Rhea DEX and the RNEAR staking pool were described as protected from damage. That separation matters because a DeFi exploit can spread if shared contracts, shared liquidity, or shared accounting links pull healthy systems into the same failure. That containment detail helps viewers understand the boundary of the breach, because a lending path failure is serious even when every connected product is not equally damaged. Users need that boundary stated plainly before confidence can rebuild. Rhea Finance SEC risk now sits at the tracing and recovery stage. The stolen assets moved through addresses on both Ethereum and NEAR. The team disclosed addresses for tracking, engaged forensic specialists, involved law enforcement, and opened negotiations around possible return of the assets. That does not restore trust by itself, but it gives users specific actions to judge. Tracing also matters for counterparties, since stablecoin freezes, exchange monitoring, and bridge surveillance can affect whether stolen assets remain movable after the first transfer. Recovery work becomes easier to judge when movement across chains is mapped clearly. NEAR intents added another useful signal by temporarily halting user operations as a precaution, while saying balances remained unaffected. That move shows why incident response matters beyond the hacked contract. When one connected service slows activity, it can stop uncertainty from spreading before teams understand whether user funds or open positions are exposed. For users, a pause can be frustrating, but it can also prevent automated routes from accepting bad assumptions while investigators are still mapping the affected contracts. A careful pause can be a protection layer during incomplete information. The open question is not whether the exploit happened. That part is confirmed. The open questions are whether funds are recovered, whether the oracle design changes, and whether users can see a clear incident timeline. A good post-incident update should explain the fake token path, the affected contracts, the addresses involved, and the exact protections added afterward. The strongest recovery message would avoid broad comfort language and instead show exactly where checks failed, which addresses were involved, and what rule now blocks the same path. Specific controls are the only way to show that repetition is harder. For Rhea Finance SEC, the next useful signal is a full technical breakdown tied to user protections, not vague reassurance. Users need to know whether pricing rules now reject thin fake pools, whether lending limits changed, and whether any connected service has remaining exposure. The lesson is narrow and practical. Oracle design is not background plumbing when borrowed assets depend on it. Until that proof appears, the useful viewer takeaway is narrow. Price feeds tied to thin new liquidity deserve special scrutiny in leveraged lending products. That is the practical signal viewers can track after the breach.